Our next question that we need to answer is, what is an account? Well, the definition of an account is it's a detailed record of the changes in a particular asset, liability, or owner's equity. An account is a basic summary device of accounting. So in this class and as an accountant, you're going to be working with accounts all the time. You already do this in your personal finance. You probably have a checking account and you might have a savings account. So those are two different types of accounts that you would want to keep track of. So in business, some common examples of accounts are, and the most common is the checking account. Every business has a checking account. Now in this class, we won't be calling it a checking account. We will just be calling it the cash account. But anytime you see the word cash account, just remember it's really just a checking account. Now another common example of an account in a business is the equipment account. And in this equipment account, you might have your printers, your monitors, and your computers. Another common example of an account in business are your debts. Now, debts are just another word for liabilities. These are the amounts the business owes to others. So you have to keep track of who you owe the money to, how much, what the interest rate is, and when is it due. And you also have an equity account, or if there's multiple owners of the company, like in a partnership, you would have multiple equity accounts to keep track of. So our next question is, what is a transaction? The book's definition of a transaction is, it's an economic event that changes the financial position of a company and has a dollar amount associated with it. So as accountants, we have to keep track of these transactions. And it's important to remember that it has to have a dollar amount associated with it. If there's no dollar amount associated with it, then it is not a transaction. So let's look at some examples. Your company might buy a computer for $800. So you would need to keep track of that in your financial records for the business because it affects cash and it affects our equipment account. We now have a computer. Another common example of a transaction is the company gets a $2,000 loan for furniture. So we have furniture that we have to keep track of in a separate account, and we now have a $2,000 loan we have to keep track of. Another example of a transaction, the owner might invest $400 into her company. So that also affects the cash account, and we need to keep track of the owner's investment. Now just remember, transaction cannot be recorded unless you know the dollar amount. So now let's talk about transactions and accountants. Accountants and bookkeepers, are really just the financial historians of a company. Accountants and bookkeepers will record each transaction in the accounting records, and in Chapter 2, we'll find out that the place that they record these transactions is called the journal. But for this chapter, you don't need to memorize what the journal means. So after the accountant or the bookkeeper records transactions in the accounting records, they need to then determine the new balances of each account. Why? Well, because you're going to get questions like this from your boss. How much cash do we have? Well, if you didn't calculate the new balance, you wouldn't be able to answer the question. Another question might be, how many assets do we have? How many liabilities do we have? Who must they be paid to, and when must they be paid? And you also might get a question like, well, how much is our owner's equity? Remember, owner's equity is just basically the net worth of the business.